Every market a part-time trader adds to their watch list brings another indicator and another 30 minutes. 5 markets cost the whole evening. I trade 23 markets across 5 asset classes in under 30 minutes. But in 2017, I was tracking 8 markets and overtrading because the complexity scaled faster than I could handle. I cut to 4 just to survive. And I'm going to show you the 3 qualifying conditions that reversed that, so that every market that you add subtracts the time instead of adding it. Every new market on your watch list probably came with a different set of indicators and a different analysis routine. In 1935, Boeing built the most advanced bomber in history. On its first test flight at Wright Field in Ohio, it crashed and killed both pilots. No human memory could hold every step the aircraft demanded, and the critics said the plane was too complicated to fly. But Boeing didn't simplify the plane. They created the world's first pilot's checklist. Same checklist for every flight, regardless of destination or weather. The next 12 aircraft flew 1.8 million miles without a single accident. That's what I call the cockpit trap. The problem was always the number of different rules per market. I apply 3 qualifying conditions to every market I trade: Forex, gold, Bitcoin, Apple stock, soybeans. The same 3 conditions in the same order, and always a binary answer. Pass all 3 and the trade qualifies. Fail one and I close the chart. Most traders do the opposite. They believe gold needs different tools from Forex, and Forex needs different tools from stocks. So they stack indicators per market. So 3 indicators generate 8 possible signal combinations per trading decision. And that sounds manageable until you hear that 6 indicators generate 64. At 64 combinations, nobody is making a trading decision. They are staring at the screen, telling themselves, I just need one more confirmation. And that one more confirmation never comes because 64 signal combinations don't converge, they conflict. I don't decorate my charts. I use moving averages on non-currency markets, and I size positions with ATR, the average true range, which measures the market's own volatility. That's it. The entire indicator industry profits from the idea that each market needs custom tools. So they have zero incentive to tell you that one universal filter handles all of them. One qualifying filter applied identically to 23 markets, and the answer is always binary: pass or fail. Adding more markets is supposed to spread your risk. But when I expanded beyond 4 markets, every new one multiplied my exposure instead of reducing it. In August 2021, I started backtesting 29 new markets. Currencies, commodities, indices, 9 of them passed my qualifying criteria, and I added 8 to my live watch list over the following months. Within weeks, my trade frequency jumped from about 1.25 per month to 3.5. That's a 280% increase in how often I was putting capital at risk. And I had not changed a single thing about my risk per trade, which is exactly what should have changed the moment the trade count went up. And it was still at 2% on every one. 4.5 months later, the damage was clear. I had lost 9 trades and 15% of my account was gone. It was my worst losing streak since I started. And that November, I kept telling myself I must have added the wrong markets. That felt like the answer. Remove the new ones. Go back to the old watch list. Make it smaller again. But one evening that November, I sat down with the spreadsheet and ran every new market through the backtest results, expecting to find the bad ones. They were all profitable. Every single one. The real story was hiding in the frequency column. I had not added the wrong markets. I had tripled my trade count at the same 2% risk, and my account was burning through capital 3 times faster than my system could absorb. the fix was cutting risk per trade from 2% to 1%. That single adjustment dropped my total annual risk exposure from 84% to 42%. And this is what I call the subtraction engine. Every time the market count goes up, the risk per trade comes down, the time per market gets shorter, and the rules get simpler. Adding forces subtracting. That's the mechanism that makes this work. The subtraction engine runs on one principle. When the number of market goes up, 3 other numbers come down. Risk per trade comes down because more markets means more trades. And more trades at the same risk means faster capital erosion. At 1% risk, even 10 consecutive losses cost roughly 10% of the account. And the recovery needs about an 11% gain. That's a setback that you can recover from. Then, time per market drops with it. The universal qualifying filter takes the same few seconds on every chart because the conditions never change. I'm not rebuilding a fresh analysis for gold that I already built for Bitcoin. Same filter on a different chart and the same binary answer. And rules per market get simpler because markets rotate. A trader locked into one asset class starves when their niche goes quiet. But a trader with one universal filter follows the opportunity wherever it moves because the rules travel with them. Each trader's dominant complexity habit bleeds their account differently, and the free diagnostic quiz in the description below maps which one is costing you the most. Check it out with the link below this video and get your diagnosis today. Fewer opinions per trade, less time per chart, and the risk per position is already set before you open the chart. The system gets lighter as the portfolio gets wider. Now, gold trades on fear, Apple on earnings, and Bitcoin on pure sentiment. Whether one filter can serve all of them at the same time sounds like it should not work. In 1983, a trader named Richard Dennis bet his partner he could teach complete beginners to trade profitably. The condition was identical mechanical rules across widely different markets. He recruited about 23 people and gave them one set of rules, same entry and exit conditions, and same position sizing. They applied these rules to currencies, commodities, metals, bonds, and interest rate futures simultaneously. More than 20 markets with one system. Over the following years, the group made over $175 million. But the detail that matters is the discipline. The most successful trader in the group, Curtis Faith, was the one who followed the rules most mechanically. He did not tweak the system for gold because gold felt different. And he did not add a filter for bonds because bonds seemed trickier. He ran the identical process on every market and let the conditions decide. The traders who tried to customize were the ones whose results fell apart. They believed their growing experience gave them the right to override the system for certain markets. And the data proved them wrong every time. The universality was the load-bearing wall of the whole system. Remove it, and every customized market becomes a separate trading strategy that has to be learned, tracked, and managed on its own. Now, look at your charts and your next trading setup. The moment you feel the pull to add a custom tool because this market feels different, you are the trader who overrode the system, and the results always look the same. My back-tested trading system generates roughly 679 signals every year across all the 23 markets. Out of those 679, only 158 become actual trades. That means 77% of every signal the system creates gets rejected. I call this the refusal rate, and it changes how diversification works in practice. When most traders add markets, they add trades. Every new chart is another chance to enter. But when a universal qualifying filter runs across 23 markets, most of those markets fail the conditions on any given day. The filter does not care that gold had a setup this morning. If it fails one of the three conditions, the answer is no. And that no is the trading edge. All 19 non-currency markets that I have backtested are individually profitable. Every single one exceeds the minimum threshold I require. The same conditions measure the same structural features in every market. The instrument changes, but the process does not. Stop hunting for the perfect system. Build one qualifying filter and apply it to everything. Tonight, open your trading charts. Pick any 3 markets from different asset classes and run the same 3 conditions on each one. The same analysis for every chart. Then count how many pass. That number tells you more about your trading edge than any new indicator you could add this year. That's the trader who manages 23 markets in 30 minutes. The one who memorized 3 conditions instead of 23 strategies. But the first time a setup almost passes the filter, you will feel the pull to make an exception, telling yourself, come on, it's so close, just this once. And once you make that exception, the next one is easier. That's how the cockpit gets rebuilt. So watch this video next where I show you the qualifying filter that makes the decision automatic so that there's nothing left to negotiate with. So see you in that video.